Hi, I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm delighted to be sitting down with my colleagues Edwina Lowe, product specialist, and Luca Raniero, head of the data intelligence team, both within our wider Data Assets and Alpha Group. And we're here to discuss the evolution of the retail investor and retail investor behaviour post-COVID. So, Edwina, Luca, thank you so much for sitting down with us today.
Thank you for having us, Eloise.
Very excited to be here with you both today.
So, Edwina, could you start by setting the scene? I think it's well known that the retail investor has increased in share of market activity through and post-COVID, most notably in the US and most notably through those 2020 to 2021 years. So, Edwina, can you provide a bit more context on this? And also, how has retail activity evolved in more recent years and months?
Certainly, Eloise. So if we look at the US specifically, pre-COVID, retail share of volumes is estimated to be in the high single digits. And really, from that low starting point, throughout 2020 and 2021, we saw a significant uptick in retail share of volumes to around, at times, 25 to 30%. And what was driving that? Well, it was a combination of factors. We saw a significant recovery and then enormous rise in share prices, and then an increase in social media participation from the retail investor, so talking about the stock market and talking about single stocks. And then alongside that, the prevalence of low-cost and no-cost brokerage apps all contributed to that significant uptick that we saw over those few years. And I think there was a perception that perhaps as life normalised post-COVID, that we would see retail share of volumes go back to pre-COVID levels. But it's become clear where we are now in the second half of 2024 that that really isn't the case, and that we saw a marked and persistent shift in retail activity. And just to be clear, Eloise, this is all US specific. We could perhaps go into other regions where the retail investor is active later in our conversation.
That's fascinating stuff, Edwina. And I guess January 2021 was the most high-profile period for the retail investor when we saw meme stocks, but also heavily shorted stocks rally significantly. In fact, our most shorted basket of more than 50 stocks was up more than 50% in that month of January 2021. But coming back to today, given that the meme phenomena isn't as prevalent and heavily shorted stocks certainly aren't rallying to the extent they were back in 2021, Edwina, how do you see evidence of the retail investor in US markets today?
So we can see in the US flows analysis done by our QDS research team that the retail investor is particularly active in consumer discretionary names and technology names, most notably including the Mag 7. Now, the Mag 7 has rallied considerably over the last few years and now makes up about 30% of the SPX by market cap and has driven about 2/3 of the gains seen in the S&P 500 over the last 3 years. We've also seen sharp swings in the meme stock names and had a recent resurgence of this just earlier this year. That is clear evidence of the high participation of the retail investor within the US.
Thank you, Edwina. So the retail investor is clearly important to continue tracking. So, Luca, over to you. You've analysed how the retail investor trades and also discusses stocks on social media. So at a high level, what observations have you made?
So we did spend quite a lot of time looking at social media data, and we combine it with other types of data sets like the US retail flow that Edwina just mentioned. It's really hard to generalize when we talk about retail investors. There's so many different types, and you can think about different wealth, different experience, different age, different trading platforms. Nonetheless, overall, we did see signs of herd behavior, and I can give you 3 key examples from my perspective. The first one, which is probably the most obvious, is they tend to crowd in certain stocks. Again, there's no hard rule for defining what a meme stock really is. But there are some common traits, like very strong personality of the founder CEO, and in general, these companies tend to have a narrative, a story. These are the ones that Chris Andrews called in this podcast a few episodes ago, the familiar companies. The second herd sign of retail investors is that they tend to follow the market, and they do that on both sides. They sell the dip, they buy the trend, and when they act, they're not really that price sensitive. The third quite interesting point is that they love to talk about what they do on social media, and they're strongly influenced by strong personality, like the super influencer that have driven the stock price and all this meme phenomenon. Is quite peculiar to retail investor if we compare with the more institutional investors community.
Thank you, Luca. And you say there that the retail investor often follows the trend in both directions. So do you see the retail investor as a leading or a lagging indicator for stock market returns? And therefore, how can we use this information to help predict future market returns?
Well, that's a very complicated question. But the real answer is a little bit of both. Looking at both end-of-day and intraday data, we do see some leading signals. And sometimes these are very strong. But it really depends on the market regime. Let me explain what I mean by that. On the one side, we have this regime that we call high retail participations. And this features strong retail flow, lots of activity on social media. Just think back on the first day of the pandemics, or even like April, May this year. What we see in this space is that retail investors clearly follow a trend, but then they prolong the trend and they support this trend through time. So what does that mean? Is that if you're able to pick up the spike early enough, the first few days where it happens, then their activity becomes a leading indicator of the price action in the next 5 to 10 days. On the other hand, there are periods, let's think about 2022, 2023, where the activity on social media is less intense. And even from a net flows perspective, we don't see such a strong activity. When we look at these periods, we need to be a bit more nuanced in the way we look at their activity and their contribution to the market. The net directional trend that we hinted about in the first part is not as sustained, but we still have ability to capture signals from their behavior. In these periods, we were able to detect other trends, different trends, but still very powerful. And I'll just mention one for the sake of brevity. We looked at this trend where retail investors actually lost interest in a stock. And what we noticed, if we are able to buy the dip, to buy those stocks that have been invested into by retail investor, but then they lost interest, they start to sell, you could argue they actually oversold some of them, then in these scenarios, we're still able to get alpha over a 10 days horizon. And to conclude, I think it's worth mentioning that what I've been talking so far is just the number of retail mentions of specific stocks on social media standalone. If we decide to layer on other angles, like short interest, like positive returns, or even the retail flow that is published by our colleagues in QDS, we see that the alpha generated by this strategy increased significantly. And I think this is one of the key differentiating factors of what we are doing, our ability to combine these data sets with other sources of data that we produce both internally and externally to generate the best alpha.
And it's worth clarifying that we as a team make both the social media volumes data and also the strategy signals available to our clients via the Fusion platform. So just taking a step back, Luca, can you explain a bit more about how you filter the millions of social media mentions to screen for single stock references? I mean, I imagine there is a lot of noise in here to decipher.
You're absolutely right. Like, noise is the right word to use in this context. And let me allow for a quick pun. How can we make sure that we're not comparing Apple, the company, with apples, the fruit? And we have put a lot of time and effort into creating a set of queries for these 3,000 years companies, broadly speaking the Russell 3000, to make sure we are hitting the right spot. And we were able to do that thanks to the help of our partners in the Machine Learning Center of Excellence in JP Morgan, who specialize in this area. And therefore, we can say with quite a level of confidence that we've been able to distinguish references to Apple, the ticker, and people who just enjoy talking more generally about their groceries. And let me be honest here, we did find some posts about people liking to eat apples. Clearly, no model is perfect, and we do appreciate that there is some residual noise. But we gain confidence from the fact that our backtesting is quite solid.
That's all really encouraging, Luca. So, Edwina, back to you. You mentioned at the outset that we've seen quite different trends from the retail investor in other regions outside of the US. So what exactly have we seen in Europe, for example?
Yeah, that's a great question, Eloise, and it's certainly harder to extrapolate retail order flow outside of the US. It's worth noting that both Chris Andrew and Claire Witz, who cover market structure in Europe and Asia respectively, have both been on the podcast talking about exactly this. But if we look at Europe specifically, generally retail share of volumes is a lot lower, albeit there are some pockets with slightly higher participation. So, for example, in Italy and Germany, it's roughly 20% and 16% respectively. If we look at the UK, it's much lower, more like 5 to 6%, although they are a bit more active in mid-caps. And really, if we think about why we see lower retail share of volumes in Europe versus the US, we can summarize 3 core reasons. One is that we don't have the same model of no-cost, low-cost brokerage apps. 2, I just don't think it's quite ingrained in our culture in the same way that it is in the US to participate in the stock market. And 3, we just haven't seen the same performance in the stock market over the last 2 or 3 years or so.
That makes a lot of sense. Thank you, Edwina. And then over in Asia, I think the picture's quite different.
Yes, that's absolutely right. I think the story in Asia is really fascinating. So just to highlight a few regions, in Korea, onshore China and Taiwan, we see retail share of volumes being in the region of 60 to 65%. However, it's even higher if we look at small and mid caps specifically. I think another region that's really interesting and certainly a growth story is the retail investor in India. It's exploded over the last 3 years or so, driven by a rapid rise in retail brokerage apps. So it's going to be fascinating to see how that continues to evolve.
Absolutely. And Indian stock market returns have obviously been very strong over recent years, which will have helped that
Definitely.
trend. So, Luca, back to you. I mean, given everything Edwina has just told us about the retail investor in other countries outside of the US, are you thinking of developing a social media data set more globally? And more generally, what's next on your pipeline for data set development?
So what we discussed so far today is mostly focused around like 3,000 US companies and the number of social media mentioned for each of them. But there's clearly more we can do in that space, and we want to be client-led. So we could go international, but there are a few challenges in that space. The first thing that we need to be aware of is that most of the models that we use have been developed thinking about the English language, and accuracy substantially decreases the moment you move to other tongues. Moreover, while the US has lots of other data available we can use to cross-validate what we do and our deductions, when we move to other regions, there's less of this data, so we need to be a bit more careful in the way we approach these regions. But before we go there are also other obvious steps for us to make. The first thing we really want to dive into is to try and understand better the sentiment around these mentions. Can we actually deliver an enhanced predictive power the moment we try and layer the sentiment on top of the number of mentions? Another area that is worth exploring is what can happen. Are we able to improve the alpha of our strategies when we increase the frequency of our monitor? It is certainly true that end-of-day mentions do have predictive power, but can intraday give us more?
Thank you, Luca. Well, there's certainly so much to focus on, so I'm looking forward to following this and checking in on this podcast series as you have more developments. So, Edwina, Luca, thank you so much for joining us today. It's been really helpful to hear your perspectives on the retail investor behaviour.
Thank you for having us, Eloise.
It was fantastic to be here, Eloise, and looking forward to chatting again in the future.
Thank you also to our listeners for tuning in to this bi-weekly podcast series from our group. If you'd like to explore our social media data set, or if you have feedback or questions, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can reach out via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.